So let's just get one thing straight right off the bat. A lot of people think of crypto as, a lottery ticket, a get-rich-quick scheme. But the source material we're digging into today, it flips that idea completely on its head. It asks us to think about crypto as an insurance policy, which of course leads to the big question, insurance against what? Well, that's exactly what we're here to figure out.
So, to get us started, the source poses this really simple question. Imagine you've got two options in front of you. In one hand, a crisp $10 bill, in the other, a digital key that holds $10 worth of Bitcoin. Now be honest, which one are you grabbing? I think most of us, instinctively, would probably take the cash, right? But what we're going to see is that this choice, as simple as it seems, actually opens up a huge can of worms.
And this slide really cuts right to the chase. The source does not pull any punches. It calls that $10 bill fake money, basically just government-printed debt. But that Bitcoin key, that's framed as a real shield, an asset that exists completely outside of that whole system. And that contrast, that's the central idea we need to wrap our heads around.
To really get why crypto is being called a shield, first we've got to understand what we're supposedly shielding ourselves from. So let's dive into the source's diagnosis of the financial system today and this idea of the rise of bad money.
Okay, so here's the first big claim from the source, and it's a bold one. It says our whole financial system is, well, sick. And the number one symptom of this sickness? Just look at all the money being printed. The argument here is that this isn't some sign of a booming economy. No, it's more like a quick fix, a band-aid solution that ends up devaluing the money that you and I have worked hard for.
And here's where we get a sense of the sheer scale we're talking about. The source points to a mind-boggling number. $1 trillion in new debt created roughly every 90 days, every 3 months. The point here isn't just how big that number is, it's the speed. It's that acceleration that really drives the rest of the argument.
Now, to explain why this all matters, the source dusts off a really old economic idea. It's called Gresham's Law, and it's super simple but also really powerful. It basically says this: bad money drives out good. What does that mean? Well, if you have two types of money and one is seen as less valuable, that's the bad money, people will get rid of it as fast as they can. They'll spend it. And the good money, the valuable stuff, they'll hoard it. They'll save it. And pretty soon, that good money just vanishes from everyday use.
And you don't even have to look that far back for a perfect example. Think about U.S. coins. Before 1965, they were made with a lot of silver, something with actual intrinsic value. That was good money. But then the government switched to cheaper metals, like copper and nickel, the bad money. So what do you think happened? Exactly what the law predicted. People hoarded the silver coins, and they basically disappeared from circulation almost overnight.
So this brings us right back to today. The source is arguing that the exact same thing is happening right now, just on a global scale. The US dollar, because of all that printing, is becoming the new bad money that people want to spend. And that pushes people to look for good money, assets that can't be created out of thin air. Things like gold, silver, and yes, according to this line of thinking, Bitcoin.
Okay, so if the dollar is bad money, what is it about crypto that makes it good money in the eyes of this source? Well, it really all boils down to one huge game-changing idea: decentralization.
This comparison really lays it all out. On one side, you have the dollar system. It's controlled by a central bank. Its supply can be expanded whenever they want, and you often need permission from a bank to move your money around. But the Bitcoin system, it's the complete opposite. It's run by a global network, not one entity. Its supply is mathematically fixed. There will only ever be 21 million, and anyone can use it without asking for permission. They're just two fundamentally different ways of thinking about money.
So, putting it all together, these are the key traits of what the source calls good money for the 21st century. Number one, it's got to be outside the old system. Two, it's controlled by a decentralized public ledger, not a central authority. Three, it's built to be immune to dilution from governments just deciding to print more. And four, it's censorship resistant.
All right, so now we can finally connect all these dots and get back to that original idea. How do all these features, decentralization, fixed supply, actually turn something like Bitcoin into an insurance policy, a so-called digital safe haven?
So how does this insurance actually pay out? Well, the source paints a picture of a financial seesaw. On one side, you have the dollar, which is getting heavier and lower as more of it is printed, and on the other side, you have Bitcoin with its fixed, light supply. The argument is that as the dollar side sinks, value naturally flows over to the Bitcoin side, pushing it up. It's positioned as a direct hedge against your cash losing its buying power.
All right, get ready for this one, because it's probably the most controversial idea in the whole piece. The source just comes right out and says it. Savers are losers. I mean, wow, that flies in the face of everything we're ever taught, right? Save your money, be responsible. But there's a specific logic behind this statement, so let's break it down. And that logic is just cold, hard math. Let's say your savings account is giving you 1% interest. Sounds okay, right? But if inflation is running at 6%, you're actually going backwards. You're losing 5% of your purchasing power every single year. So even though the number of dollars in your account goes up, what those dollars can actually buy goes down. Your wealth is literally melting away.
Now, this is important. It's not all just hype. The source is very clear that there's a ton of noise out there, so it gives us a simple test to apply to any crypto project. First, you have to ask, what is the real-world use case here? What's the product market fit? Then ask, what does the customer, the user, actually get out of this? And if the founder can't give you a straight, simple answer to those two questions, well, the source says that's a huge red flag. It's probably fishy.
And that brings us to the final and maybe most important takeaway. This isn't just about what you buy. It's about a complete shift in how you think about money in the first place. It's about moving from being a passive consumer to having a producer's mindset. The whole idea is to stop thinking like a church mouse. That's the source's term. Someone who's only focused on job security and getting a paycheck. The push is to become a producer, someone who learns the language of assets and money, and who actively looks to acquire things that either generate value or, at the very least, can't be easily created out of nothing.
This right here, this phrase, is called out as the classic sign of that closed-off consumer mindset. When you say, I can't afford it, it's a full stop. It's an answer that shuts down your brain and ends the conversation. It accepts the limitation, and that's that.
And this is the final powerful shift in thinking the source leaves us with. It's amazing, right? Just by changing that statement into a question, you flip a switch in your brain. You go from passive to active problem solver. It's not about magically being able to afford anything right away. Not at all. It's about opening your mind to finding a way. It's this one simple question that, according to the source, puts you right back in the driver's seat.